Okay, Michael Howell in this episode starts with his view on liquidity utilizing his global liquidity index. Now, this global liquidity index is cross border capital's holy grail. What is it and what does it consist of? Now, we're going to be very honest with you guys. We see Michael Howell's work that he's put in over the last several decades, and we understand that his framework has a lot of merit.
Today, I'm going to let you in on a powerful shift happening right now in the financial world. Trillions of dollars are being pumped into the system, and we're only in the early stages of what I call the money printing super cycle. But here's the catch. For most people, this will spell disaster. Your wealth, whether you realize it or not, is at serious risk. But if you know how to navigate this, it's also a once-in-a-lifetime opportunity to build lasting wealth. In this video, we'll dive deep into how this super cycle is unfolding, what it means for assets like Bitcoin, and how you can turn it into a wealth-building advantage. The insights I'm about to share are backed by the same data my team uses to make long-term financial decisions. So let's get right into it. Let's start with the basics. What exactly is the money printing supercycle? In simple terms, it's an unprecedented increase in global liquidity, the total money circulating through economies worldwide. And while most people tend to focus on US liquidity and what the Federal Reserve is doing with M2 money supply, we're actually talking about global liquidity here, a much broader pool of capital. This isn't just about dollars in circulation. It includes the flow of credit, the lifeblood of debt-driven economies, and the central banks that control it all. To get a clear picture of this, let's look at some of the leading minds who are tracking global liquidity. First, there's Michael Howell, who developed the Total Liquidity Indicator. This tool is one of the most reliable ways to track the movement of global liquidity, and he's provided some groundbreaking insights. Then we have Nick Bhatia from the Bitcoin layer, who's created his own global liquidity index. And finally, Raoul Pal from Real Vision, who's also established an index to monitor this flow.
Michael Howell's framework is all about the flow of funds. So when he refers to liquidity, it's not in the same way that you might think of liquidity in terms of a certain asset being very liquid and having a high degree of liquidity. So when we think about Bitcoin's liquidity, we are talking about how much money can move in and out of Bitcoin without moving the price too much. If it can, then Bitcoin would be thought of as very liquid or have a lot of liquidity. US Treasuries, the liquidity around US Treasuries is something that's often discussed. So as one of the major asset classes across the entire spectrum, right, it is the foundational interest rate within the US dollar spectrum, this US Treasury curve. So there's a high degree of liquidity in the instrument, especially when we get into Treasury futures. But when we think about the Treasury market individually, each Treasury security would theoretically have a different amount of liquidity. Why? Because each Treasury security was issued at a different time. So the 10-year Treasuries that were issued this month are a different security than the ones that were issued 3 months ago, for example. So each Treasury security out there has its own liquidity challenges, with the backdrop of the whole asset class having a high degree of liquidity because they are US Treasury securities, and there's a large quantity of them. So liquidity for securities and liquidity for asset classes in terms of money being able to move in and out very quickly without moving the price too much. That is a definition of liquidity that you and I are all used to. And when we hear the word liquidity quoted in the financial media, we're actually hearing people refer to how much money is in that particular asset class and how easily it can move in and out.
Each of these indicators is built slightly differently, but they all tell the same story. We're witnessing a liquidity surge of historic proportions, and it's set to reshape the economy in ways we're only beginning to understand. Now, what is global liquidity exactly? It's not just about the cash in circulation or what's sitting in savings accounts. It also includes the flow of credit, essentially the ability to create new money through loans, mortgages, and other types of credit. For example, when you take out a loan for a house or a car, that money is essentially created and added to the total liquidity in the system. This isn't limited to traditional banks either. It includes shadow banks, private equity funds, and non-traditional financial institutions that can generate liquidity quickly, often referred to as the shadow monetary base. This system operates alongside central bank balance sheets, but it's even larger and more complex. For a rough measure of global liquidity, we can look at M2 money supply. That is, the total amount of cash and checking deposits in circulation. But a broader and perhaps more accurate picture comes from examining the balance sheets of the 5 major central banks around the world. Currently, when we look at global liquidity in US dollars, we're seeing record levels. According to Michael Howell's indicator, global liquidity is now over $175 trillion, with a $1 trillion increase in just the past year. This surge in liquidity is reshaping financial markets and pushing asset prices to new highs. But here's where things get interesting. As liquidity goes up, asset prices typically follow, making this super cycle an environment where you can either lose big or win big, depending on how well you position yourself. Now, liquidity moves in cycles, much like waves, and these waves have predictable patterns. Historically, we've seen 4-year cycles tied to various factors, including the presidential cycle, the Federal Reserve's monetary policy adjustments, and even the Bitcoin halving cycle. Each of these cycles plays into how liquidity flows into and out of markets. The last major reset was in 2008 during the global financial crisis. Since then, we've seen this pattern repeat every 4 years, 2012, 2016, 2020, and now 2024. Each wave of liquidity not only boosts asset prices, but also creates economic expansion and the opportunity for savvy investors to capture gains. Let's zoom in on the United States for a moment. Since around 2019, the US monetary base, or M2, has been expanding at a rate of about 10% per year. This is a critical trend because it essentially means the money supply is set to double every 8 years. By 2032, if we continue on this trajectory, global liquidity could reach $350 trillion. And the data tells us this is not just a projection, it's happening in real time. In fact, the U.S. Congressional Budget Office, CBO, and global entities like the International Monetary Fund, IMF, are already preparing for a future where money supply expands at a rapid clip. Why does this matter for you? Because assets like real estate, stocks, and especially Bitcoin thrive on liquidity. These assets, priced in dollars, respond directly to increases in the money supply. When the denominator, in this case the US dollar, expands, it pushes the value of the assets up, not necessarily because the assets themselves are more valuable, but because it requires more currency units to purchase them. This trend is most visible when we look at assets like the S&P 500, real estate, and of course, Bitcoin. They move almost in lockstep with global liquidity, and as liquidity increases, so do these asset prices. Let's talk specifically about Bitcoin, an asset that's extremely sensitive to liquidity shifts. Over the past few years, Bitcoin has shown an 83% correlation with global liquidity. This means that as liquidity goes up, Bitcoin's price tends to follow. Other assets like the S&P 500 and gold also have high correlations with liquidity, but Bitcoin's sensitivity makes it stand out. The more liquidity flows into the market, the more upward pressure it puts on Bitcoin. This creates a unique opportunity and also a significant risk if you're not positioned correctly. Interestingly, for every billion-dollar increase in M2, Bitcoin has historically seen a 1.37% increase in price. Just in the first 5 days of October this year, the US alone added nearly $400 billion in liquidity. If this trend continues, Bitcoin could see substantial price appreciation, especially as more liquidity flows into the system over the next year. In fact, projections using models like the power law suggest that by 2032, Bitcoin could reach prices as high as $1.5 million per coin, assuming it captures even a small share of global liquidity. Now let's look at this from a broader perspective. Bitcoin isn't just competing with gold as a store of value. Today, people use a wide range of assets to preserve wealth. Everything from real estate and fine art to stocks and bonds. Bitcoin has the potential to capture a small but meaningful share of these markets. If Bitcoin were to capture just 5% of the global store of value market, it could be worth between $2 and $3 million per coin. While this may sound optimistic, consider that disruptive technologies like Uber and Airbnb also started by capturing just a small percentage of their respective markets. Over time, these companies redefined entire industries, and Bitcoin has the potential to do the same in finance. This shift is also part of a larger technological wave, what I call the quantum wave cycle. Roughly every 50 years, we see a major leap in technology that fundamentally changes how the world operates. Bitcoin, decentralization, artificial intelligence, and robotics are all part of this new era. As we enter this next phase, we're witnessing the second stage of the S-curve, the steepest part of the adoption curve. This is where things get interesting. Just like the growth we saw with ride-sharing apps or short-term rentals, Bitcoin and other decentralized technologies are poised for exponential growth. So what does all this mean for your portfolio? Traditional asset allocation strategies like the 60-40 portfolio of stocks and bonds are becoming outdated in this environment. Adding even a small allocation of Bitcoin, say 1% to 5% of your portfolio, can dramatically improve returns over time. Historical data shows that a 1% allocation to Bitcoin over the past 5 years would have boosted a traditional portfolio's return by 177%. A 5% allocation would yield a 30% return, and a 10% allocation would result in a 47% boost. This highlights the power of incorporating alternative assets into your portfolio in a time of high liquidity and rapid monetary expansion. Finally, a quick but essential note on security. If you're holding Bitcoin or planning to invest, take control of your assets. For the first time in history, we have a way to preserve wealth securely and privately with Bitcoin, but it's crucial to store it safely. Don't leave it on an exchange where it can be hacked. Use a hardware wallet, like a Trezor, to protect your private keys. With a hardware wallet, you control your funds. And in a world where central banks are printing money at unprecedented rates, this kind of control is invaluable. In summary, the money printing supercycle is creating both massive risks and unique opportunities. The decisions you make today about how to protect and grow your wealth could shape your financial future for decades. As global liquidity rises, assets like Bitcoin, real estate, and stocks are likely to see substantial gains. Whether you're a seasoned investor or just getting started, understanding this cycle can give you the edge you need to turn this challenge into a wealth-building opportunity. I'll be diving deeper into these topics in future videos, so stay tuned. And if you're ready to learn more about positioning yourself for success, join me next week as we explore the quantum wave thesis. Until then, protect your wealth and stay informed. To your success. As always, I'll keep bringing you insights, updates, and strategies to help you stay informed. If you found value in this discussion, don't forget to like, subscribe, and stay tuned for more content. Remember, this isn't just about today. It's about planning for tomorrow, staying vigilant, and positioning yourself for whatever comes next. Thanks for watching, and I'll see you in the next video.